Good evening, everybody. And tonight we've got the great pleasure of having Brad Powell back with us. Brad is a self-directed trader that has come up with his own successful strategies, which work very well on ETFs. So that's what he's going to be kind of oriented toward tonight. So with that, Brad, welcome back. We're anxious to see your information.
Thank you, Steve. Hi, everybody. I'm Brad Powell with ETF Dynamics, and I want to thank Steve and the whole team at Candlestick Forum for having me back. It's been a while since I've been here in the webinar room, but I'm a huge fan of Candlestick Forum and what Steve does. And I attend a lot of live educational webinars and really enjoy them, both attending and presenting. So hopefully you'll find some information useful. In case you have to leave earlier, in case your computer crashes or something, I'm going to go ahead and share a link to a free ebook download you can get. And a lot of what I'm going to be talking about this evening is actually in the ebook in a little bit more detail. And it's not only specific to ETFs, but also talks about some divergent strategies if you're interested in learning a little bit more about divergence, which is what we at ETF Dynamics trade and what our strategies are based on. When you're trading ETFs, and this is also true of stocks, maximizing profit potential to a certain extent true of stocks, maximizing your profit potential and controlling risk begins before you actually ever place the trade. A very good trader that I used to trade with, a guy I knew for a long time, unfortunately passed away a couple of years ago, used to always say, plan the trade and trade the plan. And I think that is just such a great motto for traders. In any market conditions, you need to have a plan before you enter the trade. The first half of this information is going to be kind of general information about ETFs and hopefully some things you don't know about ETFs. And then in the second half of the presentation, I'm really going to dig into some technical analysis tools in depth. I'll give you the settings, everything, and show you how we like to use them to attempt to maximize profit and also to control risk, which, as we all know from yesterday, is very important when you have money in the markets. The first and most important thing is to know what you're trading. And again, this is true of stocks as well. Not just to jump into something without knowing what news might affect it, but in today's ETF markets, the broad range of ETFs that are available can actually be very confusing. And I'm going to give you a case in point. A sector that has been in play really since Trump was elected president is the financial sector. And three of the most popular ETFs are the XLF, which is the unleveraged ETF, and I want to point out that that's the Financial Select Sector Index. And then the UIG, which is a double leveraged bull ETF, so it's going to return twice the daily move of its underlying index, and that's the Dow Jones U.S. Financials Index. And then the FAS, which is a triple leveraged ETF, very popular, heavy volume, very popular for the financial sector. It's the Russell 1000 Financial Services Index. And I want to point out that all three of these are based on different indexes. There's not a triple leveraged for the actual Financial Select Sector Index. There's not a double leveraged either. There's not a triple leveraged for the Dow Jones U.S. Financials Index. They're all based on different indexes because of who the issuer may be of the ETF. You know, the FAS is Direxion. They tend to base a lot of their ETFs on Russell indexes. And why is this important? Well, from 2/2/2017 to 3/1/2017, so 1 month, the XLF, which is the unleveraged ETF, gained 8.5%. The FAS, triple leveraged ETF, gained 22.8%. So those are nice returns. But if you went into a triple leveraged ETF expecting to get 3 times 8.5%, you should have got 25.5%. The problem here was you lost about 3%. When attempting to maximize profit. So I personally trade the FAS. I enjoy trading the FAS, but I know it's never going to give me 3 times the return of what the XLF is going to do. So if you can afford to you would have been better off buying 3 times the amount of the XLF as buying a position in the FAS. You actually would have gained 3% more. And the other thing to take in consideration there is your risk is greater with the triple leveraged ETF, so if the trade had gone against you, the XLF would have been more stable than the FAS. Triple leveraged ETFs have a tendency to overreact. Market moves down, and we'll get more into that in a minute. So you actually would have had greater risk with less potential reward if you were looking for 3 times the move of the XLF. So this is why I say, and this is just, there's many examples of this, it's very important to know exactly what you're trading in ETFs, to do your research, check if they have erratic volume, which can kill you, and we'll get into that in a minute. So factors to consider for when you're looking at both your potential profit and your potential risk. Start with the amount of leverage you trade. And that's one of the great things that I love about ETFs. You can look at a trade setup and change your leverage based on how good of a trade setup you think it is, or based on whether the markets may be in a stagnant period. You know, it's been, and I'll just comment on this, it's been a very odd year for stocks, especially if you trade divergence. Shorter time frames have been giving some very good divergent setups, but like daily charts haven't been giving many setups at all, because we're seeing a type of market where we flatline for 3 or 4 weeks and then make one burst up. Flatline for 3 or 4 weeks, maybe have a quick dip down and then burst right back up, which is kind of what looks like is going to happen again if the Comey thing doesn't get blown out of proportion. And that's not, those aren't the type of market conditions, you know, for divergence traders. We'd like to see volatility. We like to see consistent price movement. We like to see technical pullbacks to properly set up divergences. And so shorter time frames have been doing that. Daily time frames really haven't, but like 2-hour and 4-hour time frames have, and we're going to be looking at some examples from those in a little bit. Most markets that you'd want to trade in ETFs, most sectors have an unleveraged ETF or ETN that will track the underlying sector, index, etc. Double leveraged ETF that seeks to return twice the daily percentage move, and that's in quotes, and that this is very important, and I'll talk more about that in a minute, of the underlying sector. And inverse ETFs, unleveraged and double leveraged, which means they will go up if the underlying index or sector goes down or commodity goes down. So they're called bear ETFs or short ETFs because you're essentially short the market. Some markets offer triple leveraged ETF and a triple leveraged inverse ETF. Not all markets do, but many do, especially the more popular sectors, like the semiconductors. You know, of course, the major indexes all do, and we'll look at some examples from those again in a little bit. I want to come back to this line. Over a period of more than 1 day, a leveraged ETF may return more or less than expected. And the reason for that is they are rebalancing leveraged ETFs on a daily basis. So whereas the SPY will perfectly track the S&P 500, you know, within a couple of pennies, the IWM will perfectly track the Russell 2000. This isn't necessarily true of double and triple leveraged ETFs. And I like to use 2013 and 2014 as cases in point because there were such dramatic differences between the index and the triple leveraged ETF. So in 2013, the IWM returned 38.69%. Triple leverage should have returned 116.07%, but the TNA, the triple leveraged ETF, actually far outperformed what it should have, returning 146%. Conversely, the TZA, the bear ETF, should have gone down 116%. It only went down 68.58%. Only, of course, being a relative term, if you were in it for the year, you'd be pretty upset at the end of the year. In 2014, which was more of a kind of flat year, volatile year, not quite the same type of bull move that we saw in 2013, IWM returned a little over 5%, so triple leverage should have been 15%. Triple leverage ETF really didn't return, you know, a little bit better than the IWM, but not anywhere near what you'd expect. Conversely, the triple leveraged ETF lost more than or almost double what it should have. So in the short term, Generally speaking, a triple leveraged ETF will outperform, meaning, and by short term I mean, you know, a 2-day to 2-week, even 1-month period. The triple leverage ETFs often outperform the underlying index, whereas in longer time frames they often underperform unless it's a very strong prolonged move, because they're constantly rebalancing every day to try to match that 3%. It's not an exact science. Another factor to consider is the volatility of the underlying market. This can be combined also with the leverage. And the example I like to use is precious metals. So if you wanted to trade precious metals, you could look at gold or silver, right? So in green we have, and this is a percentage chart, in green we have the silver ETF, and in red is the gold ETF. And you can see during this move up that silver returned basically twice the percentage that gold did. So if you're a more aggressive trader and you're looking to really maximize profit, you have a good trade setup, you might want to go into silver as opposed to gold. The two indexes more or less always track each other. Conversely, if you're adverse to risk and don't want the excessive risk, you'd be better off in gold, because as you can see during this move back down, silver went down about 10% more than what gold did. And silver is inherently a more volatile market than gold. It doesn't have quite the same stability. If you're looking at major indexes, in green we have the SPY, and in red the IWM, which is the Russell 2000. The Russell 2000 is an inherently more volatile market than the S&P 500. And this is an important point to be aware of. So you can see during a move up, Russell 2000 is going to return more, but when it comes back down, whereas the S&P 500, we can see in this middle period here, just goes into a flat line consolidation, there's actually about a 10% drop in the Russell 2000. But when we get back into a bull move, the Russell 2000 is going to far outperform. So these are important things to take into consideration before you start trading ETFs, and they're important considerations for how aggressive of a trader you are in balancing your risk to reward levels. Another factor to consider for both profit and risk would be the potential for overnight gaps. And as we saw yesterday, even the S&P 500 or the Dow can have a 1%, 2% gap down, or as we saw after Brexit, you know, an enormous, I think they all gap down around 4%. You know, I typically trade at ETF Dynamics. We typically trade with somewhere between a 2 to 2.5% stop on an index on an unleveraged ETF. So triple leveraged is somewhere, it could be as low as 5%, as high as 7.5%. You know, in a big gap, it can bypass your stop and you're going to take a bigger loss. And this is especially true of overseas markets. If you look at the gaps here, this is the FXI, which is the China 25, kind of the equivalent of the Dow Jones Industrial Average in China. They're a big cap index. You can see that this is an unleveraged ETF. There are doubles and triples for it as well. But in the unleveraged ETF, you can see 3 to 4% gaps on a fairly regular basis. Now, this is a volatile trading period, but it's a kind of simple equation. Those markets are open while U.S. indexes are closed. And so everything is going to be priced in. Whatever they've done the prior day is going to be priced in to the opening gap. And that's something to be aware of, because, for example, if you were short here and maybe you had a trailing stop, when this green candle, when it gapped up, it's gonna bypass your stop, and that's something to be very aware of. It's no different than a stock, though, that reports earnings and misses and gaps down 5% or 7%. You know, like Cisco today, that gaps down, you know, 4 or 5%. It's just something to be more aware of in the ETF world, especially because of leverage. Because if you have a 4% gap in an unleveraged ETF, the triple is going to be 12%, and that's a pretty big hit if the trade is going against you, and it's something to consider when deciding what to trade. we really like trading the emerging markets. The EDC is the triple leverage bull ETF. The EDZ is the bear ETF. For the emerging markets, if you want to go single leverage, you can do the EEM. We really like the MSCI Emerging Markets Fund because even when you have, this is the same period of time or part of the same period of time that we looked at on the FXI chart, the gaps aren't quite as big. And the reason for that is some of the stocks that are in the MSCI Emerging Markets Index trade in Korea, trade in China, so those markets are open while our markets are closed. But a lot of them also trade in South America, Australia, different portions of the world that have an overlap with U.S. equity indexes or are open during the same hours. So the EDC typically has, or the emerging markets ETFs, will have large gaps, but typically leave enough room for intraday trading or short-term trading, or that you're not going to get creamed by a big gap. So this is market we like, but you do need to be aware you can still have potentially, like we see here on this move down right at the beginning of 2014, a very large opening gap. And the last thing to really consider when looking at ETFs is liquidity. You know what? I see new ETFs issued all the time, and ETFs are canceled all the time. There's currently, I think, about 1,400 ETFs actively trading. They represent about 25% of daily market volume, which is phenomenal when you think about it. Product that's less than 25 years old. At the same time, they come and go. And some can have very erratic volume. Some of that can be based on seasonality, or some of it can be because the sector goes in and out of play. There's a few sectors, and while I'm thinking of it, because I forgot to create a graphic, where there are a few sectors that I think are very much in play, and I'll just mention them, which are that all have a multitude of leverage, or all three leverages available. Semiconductors are going to be very much in play over the summer. The SMH index, biotechnology. They're fantastic biotechnology stocks. We're going to look at some trades from one in a couple of minutes. That's a sector that should continue to be in play. Don't overlook real estate, especially if you're maybe looking to hedge or looking to the bear side. Real estate hasn't been real strong compared to the financials. That's another sector that will remain in play over the summer and next year as interest rates potentially go up. But real estate could potentially go down as interest rates rise, and there's less demand for new homes because of rising mortgage rates. But it's been a very active sector. It was dead for a couple of years. It's suddenly active again. So those are some sectors to keep in mind: biotech, semiconductors, financials, and then of course the major indexes and real estate to keep that in mind. What we're looking at here is the DBA, which is the double bull ETF for agriculture. And when we talk about liquidity of the market, you can look at seasonality here, that in the spring it becomes very active, and the rest of the year it tends to die, where you could have volume as low as 100,000 shares versus 3.5 million shares when it's really in play. And why is that important? Slippage. If you're in a position and you go into one of these dead periods of time where volume is very low, you could incur more slippage on a stop or trying to exit with a profit. You can see much wider spreads. Instead of a 1-cent spread when there's a lot of volume, you might get a 5-cent spread, 6-cent spread. And those are all little minor factors that can cut into your profit or increase the stop amount to slightly more than what you normally want to have. So it's always a good idea to look at volume on something you're going to trade. And you compare that to the SPY, where on a bad day you get 20 million shares, and on a good day you trade 250 to 300 million shares. You're never going to have to worry about anything more than a 1-cent spread. There's always going to be a bid and ask large enough to absorb your trade. Even if you're trading with millions of dollars, it'll absorb it. And that's a really important factor to consider for both maximizing profit and controlling your risk, is know the liquidity of the ETF. And the same is true of stocks. I've gotten stuck in a stock before that volume just dried up on it, and suddenly there was a crazy spread. And if you want to get out, you may not be able to get out at the asking price, and it's always difficult. So a few tools to keep in mind for maximizing profit and controlling risk. Be aware of sectors in play so that you don't get trapped in dead volume. We like to use what we call adaptive indicators for placing stops. We're going to get into this right now. And another method of really maximizing profit is comparing multiple time frames. So I'm going to show you a chart picture. This is the FAS triple leveraged ETF just on a daily setting for the financials. And this is what it did after Trump got elected until a couple of months ago. And it's been kind of dead and sideways since then. But there were some really strong moves. And I'm going to go over, I'm going to click to a graphic and show you exactly what I have on my chart. I have a Keltner channel, and that's the magenta, and I'll go back and show you. And I've gotten rid of the midline. I've made it invisible. And again, these settings are all in that free ebook. So if you want to get that to review this, or you don't have a pencil and paper to write it down or don't have time, they're in the ebook, which you can get. So the Keltner channel, the settings are 20, 2.5, and 0 with the midline invisible. So the 2.5 setting default is usually a default of 1.5, and most charting platforms call that number of ATRs. And you want to change that to 2.5, which gives it kind of a better trading range for the implied trading range for what we're using it for. In green, I have a 21-period EMA, and in yellow, I have a 9-period EMA, which is similar, to the T-line, which I think is very similar. And you'll see how we use it slightly differently, though, than the way I know Candlestick Forum and some other people like to use the T-line. So those are the three indicators. So I did not, on divergence, get a long signal at the bottom before it took off on daily charts. We did on the 4-hour chart, and I'm going to look at that in a minute. I got a trade set up on the 4-hour chart. The 4-hour time frame is a time frame I love, by the way, and we really go in depth about the 4-hour time frame in the ebook because it tends to always produce signals of that are very good for divergence-based trading. But let's pretend like on a daily chart you got a long signal here, because I just want to show you how in a strong trend we would use these tools to assess our initial risk and then to trail our position, to adjust our stop. So our initial stop, because the long signal is generated over both the 9-period EMA and the 21-period EMA, would be a little above halfway between the lower band of the Keltner and the 21 EMA. And the reason, during a choppy market, the reason we say a little bit below, maybe 1% below, 1.5% below on a triple leveraged ETF, is during a choppy market, in case this chop hasn't ended, you're just going to go right down and get stopped out, and then the market's going to bounce right back up. It's going to weave up and down over these EMAs and go flat as it did here during the early fall and most of the summer of 2016. Then it broke out after the election. Most of the summer of 2016, excluding Brexit, the 3 or 4 days of the Brexit craziness. So our initial stop is going to be slightly below. Kind of a good indication is a little above halfway between the lower band of the Keltner and the 21-period EMA. Once the trade is going in our direction, and especially once it breaks up above that outer setting of the Keltner channel, we'd get our stop up into profit. Again, this is a theoretical trade. I'm going to show you a real trade right after this on the FAS from the 4-hour. Again, we're trailing down, 1.5% below the 21 EMA, stops into profit, and as it continues going, we're just continuing to move it up every couple of days or every day with that 21 EMA. It's such a sharp rise, you can actually do it every day. You can't always do that, but in this type of move. And I want to point out that it's very rare to see any index or sector or even stocks stay outside of the Keltner channel for more than 3 or 4 days without coming back down to at least the 9-period EMA. It's even more rare to see the 9-period EMA go above the upper band of the Keltner channel. But this is an anomaly in trading. This was an unprecedented move after Trump was elected president. And there was never much of a pullback for more than one day. And so it kind of broke some rules, but I don't think I'd seen that in years where anything stayed outside the Keltner for that long. So you continue to move our stop into profit. The first time the daily candlestick closes back inside the Keltner channel, we're still riding our stop under the 21 EMA, but we're making a note of that. That's what we call our first or preliminary exit. We're not exiting the position, but we're aware of it, that it has come back in. Now, under normal conditions, we'd expect retracement to the 21 period EMA and then the next leg up. But here, it doesn't do that. It shoots right back up. We get our second close inside the Keltner channel here, and we exit half our position, and now our stop goes up to the halfway point between the 21 period EMA and that 9 period EMA. And that's where our trailing stop is now to protect profit. And then if we get a third exit signal, it bounces back up, closes in a third time, then we exit the second half of the position. And it worked out perfectly on this trade. This is a picture-perfect trade. It's not always going to work out like that. More times than not, this is a pretty good rule of thumb to follow. Using these adaptive indicators to know where to place your stop, leaving enough room to stay in the trade during a poke blow, especially in a volatile market like the financials, and how to place our initial risk on the trade, which in this case was about 5.5%, which is not bad for a triple leveraged ETF, a little lower actually than we'd expect. So now I want to look at the 4-hour time frame of the same move. And I actually did get a divergence-based signal, a hidden divergence for the beginning of a new trend, set up perfectly here. And the initial stop is going to be below this price pivot. If it were way down here, we'd ignore the price pivot because the signal comes so far above the 21 EMA. But because the price pivot's right around the EMA, initial stop is below here, roughly about a 6% stop, which is what we expect on a triple leveraged ETF in a somewhat volatile market like the financials. But this gives us enough room if it kind of consolidates a little bit more before going up. In this case, it kind of inches its way up and then takes off. Once it's up and outside the Keltner, what are we doing? We're keeping it a little bit below, about 1% below the 21 period EMA, and riding it. And we're looking for our first close back inside the Keltner channel. And we get it here. So we make a note of that, keeping our stop a little tighter under the 21 EMA. We expect it to actually pull back to the 21 EMA and then shoot back up. Something very odd happens. The next day, it goes back up above the Keltner, and then it comes back down inside the Keltner. So technically, this is 2 closes in a row, but they're only a day apart inside the Keltner channel. So would you want to exit half your position here or stay with the trade? This is a really strong trend. We would expect this type of trend to continue, potentially come back down to the 21 EMA, and we already have a lot of profit going here. So what can we do to stay with this trade a little bit longer? And it's to go out to the daily time frame and just reference what it has done. And on the daily time frame, we're only getting our first close inside the Keltner channel when we're getting our second close inside the Keltner channel from the 4-hour time frame. And we've retraced right to the 9 period EMA. And in this fast-moving trend, as you can see, it's kind of bouncing off the 9 period EMA in the 4-hour, and now we would expect it. Oh, I think I went the wrong way. Sorry, I went the wrong way. We would expect it to do so on the daily as well as the 4 hours. Back to the daily. So instead of exiting half, you can just move our stop up under the 21 period EMA, stay with the trade, and let it ride until we exit half at what is technically the third exit signal, but on the daily chart, it's the first close back inside. It's this first close back inside the Keltner channel, or I'm sorry, second close back inside the Keltner, so we'd exit half the position from the daily chart and stick with the 4-hour using our stop up here halfway between the 21 period EMA and the 9 EMA. Hopefully that makes sense. I got a little confused on where someone says they can't. If you can't pull it up with the URL that you got, it should work fine. Just go to our homepage, which is www. Roger. It should work fine, but every now and then somebody has problems with it for one reason or another, so you can get it at our homepage as well. So let's move on now to the biotech index, 4-hour time frame, and see, do these same rules work in another index at a totally different period of time. And on the 4-hour time frame, on this big candle here at the end of the day, get a long signal, a very nice divergence-based long signal. I'll get into divergence in just a minute on the next chart. Because it's up above the 21 EMA, our initial risk is going to be below daily low, and it's a little above halfway between the lower part of the Keltner and the upper part. Again, this is a double leveraged ETF. This is about a 4% stop, 5% stop. It's about as large as we'd want, but biotech can be pretty volatile. So as price starts going up in our direction, we expect it to come back down to the 21 EMA. It kind of punches out of the Keltner here and closes just right above it. We expect it to come right back down to the 21 EMA and maybe poke a little bit below it as it did here and turn back up. We get up here, we get our second close below the Keltner, inside the Keltner on the 4-hour. We expect it to come back into the 21 EMA. So if we exited half here and put our stop here, we're going to stop out on the 4-hour time frame. How could we potentially stay with this trade for this next leg up with our full position instead of only half a position? So again, let's manage the trade from the daily time frame because we're already in a nice profit. And I want to qualify this. If I didn't already have a nice profit on the trade, I wouldn't do that. I'd go ahead and get out because maybe a market reversal is coming. We don't know what the future holds. Because you're have a nice profit on the trade, for me, it's better to try to hold it for a bigger move, and I'll be happy with the amount of profit I have initially. If it reverses, it's already in like an 8% profit, the stop on a double leverage ETF. I'll be perfectly happy with that, but I want to try to hold my entire position for the bigger move. And so by managing the trade off the daily time frame, you can see we would hold it until we get the second close off the daily, just like we did with the FAS, and now take off half the trade and move our stop up a little bit above the halfway point between the 21 EMA and the 9 EMA, just to protect against just a momentary poke. And so we're still in position for this big move with our full position. Now we've got half off, and in this case, it actually came back and stopped out, and we got a trend reversal. So it made it even better that we held it through the duration of the move. And not all trades are going to work out this way, but more than not will using this rule set. Let's move to one more. This is very recent. TQQ, which is the triple leverage bull ETF for the NASDAQ 100, and again from the 4-hour time frame. And you can see the divergent setup. I'm just going to briefly say again, this is in the ebook. This is a stochastic, and the settings are 5-3 instead of the default at 12-3. The period is moved to 5. So like in Thinkorswim, it's a fast stochastic, and I'm only looking at the fast D. In TradeStation, which is what I trade off of, it's a slow stochastic, but I'm only using slow K. Slow K of the slow and fast D of the fast are the same thing. In a full stochastic in some charting platforms, you're using the percent K, but in any case the period will be 5, or sometimes it's called the K period or the D period, depending which one you're using, will be at 5, and then your smoothing or percent K on a full stochastic will be 3. So instead of 12-3, the settings are 5-3, which is usually the default is 12-3, and we go to 5-3. It's a little bit faster setting. It's a little noisier, but you can see the divergence-based price goes lower from this point to this point, and then the stochastic hooks up. and we get in. So where's our initial stop? So we're going to use this last pivot low, a little bit below it, and because we're right down at the bottom of the Keltner, the lower band, we're going to go slightly below the lower band of the Keltner channel. And unfortunately, the trade goes against us for the next 4 hours. This was the same day, and it wasn't looking too good at the close, but it comes back up the next day. And I think what's going on? It was probably French election concern at the time was probably the worry of the week, as I'm calling it. You know, now it's the Comey. It's like every week there's something new, right? The worry of the week. So as the trade gets going, it takes a while, but we're going to start reducing risk. And so we're going to use this halfway point between the lower band of the Keltner. And then once it breaks up above the 21 EMA and the 9 EMA strongly, we're going to use a little bit, you know, tighten it up a little. This is still kind of a dicey trade. Well, it happens to gap up and go in our direction. We can finally get our stop into profit when it breaks out of that upper band of the Keltner channel and closes up above it. Once the stop is into profit, you know, we're just doing the usual, waiting for that first close inside the Keltner. We get it here, still running our stop, you know, about 1.5% underneath the 21 period EMA. We get our exit, you know, here, exit half the trade on the second, or as we've seen, and our stop would have moved all the way up here, we would have gotten stopped out and missed the next leg up. So we also would have had the option to exit half and use our stop off the daily chart, which we'll look at in a sec, or just stay with the entire position and manage it from the daily chart. So here's the TQQ daily. This is where we took the trade. You can see in the last 4 hours it went back down. And where we were taking that exit, we haven't even come back inside the Keltner channel on the dailies. So you can stay with the entire position and keep your stop under the 21 EMA. No matter what you did, it got stopped out yesterday. Whether you're managing it from the 4-hour trade, we just saw the big hit yesterday, the gap down, the worry of the week, and everything stopped out. You know, the trailing stops were taken out. But you still had such a nice profit on the table that it's worthwhile, we feel like, to stick with it. You know, stick with it, manage it from the dailies when you have that much profit. So I'll open it to a Q&A first. I'll share the direct link again. You can get our free ebook. It really goes into everything that I've talked about here today, much more in depth, and it has all the settings listed in it. You know, we don't keep anything proprietary. Everything's fully revealed. You can kind of look at how we like to approach divergence, and it's I've shared the link with you here. It's our free guide to trading ETFs. Talks more about how leveraged ETFs differ from tracking spiders, some common pitfalls trading leveraged ETFs, our criteria, and a list of our favorite ETFs for trading. It breaks it down with sectors and the best leverage stocks that have consistently proven to have good volume, you know, meet all of our criteria for trading, and kind of a primer of divergence and a fairly simple divergence strategy. If you want to look at divergence or study divergence or incorporate it into your own trading, then all of these trade management techniques that we've talked about here. Michael Weber asks, hang on, so I'll get to the question. What are the main differences in advantages of Keltner? All right, so Bollinger Bands, we're using, because we're using, you know, Bollinger Bands are going to show you where, my understanding, I'm not, of the way most people use them is, they're going to show you specifically where to get out. For us to exit a trade, we want to look for a divergence signal. And like all of those trades I show you, we never had negative divergences that said exit this trade now, because there's a negative divergence. Just negative divergences weren't setting up because the trend was so strong. Bollinger Bands, you're going to like hit the top of that Bollinger and get out. The Keltner, we're not using it that way, the way Bollinger Bands are going to be used. It tends to be smoother and not as erratic as the Bollinger Bands, or certainly not as volatile as the Bollinger Bands. We're using it more for looking at stop where are we going to be placing our trailing stops, and where are we going to place our initial stop. So we don't want that one-day volatility that you might get. You know, if you have one big up day and you can get a huge spike, or one big down day and get a huge spike down, in Bollinger Bands, the Keltner is not going to react that same way, you know, in a one-day period. And that's why we prefer the Keltner for our uses. And nothing against Bollinger Band trading. I know some people very successful with it. The way we're using it, Bollingers just don't work as well. Can you use the system on smaller time frames? Yes, you can. You know, divergence works great. I mean, I used to trade a lot. I trade futures in the morning. I trade the NQ on range bars, 6-tick range bars. We have a little bit broader, expanded strategy, divergent strategy, that there's a link to it, very low cost, $37 strategy in the free ebook, where we get hot and heavy into like 5-minute and 8-minute time frames, and then everything in between. Another great time frame right now has been the 2-hour time frame, especially if you understand hidden divergences with a fairly fast stochastic. You know, at that 5 setting, you get a lot of hidden divergent setups to get in with the trend if you missed the bottom, or you missed that, you know, breakout day, to get you in the middle of the trend, and that's kind of our bread and butter. Not work using Chrome. Hi, Carol. I don't know why that URL is, for some people, isn't working in Chrome. I do everything in Chrome, and nobody else has had a problem. Do I actually use? I look at candlesticks. I am aware of them. They're not as important to me because, or us at ETF Dynamics, because we're basing it. The question is, do you actually use Stevens Basic 12 reversal candlestick patterns? I love it when they can confirm what we're doing off of divergence. I'm a big fan of Steve's. I know we have some clients for many years who are members also here at Candlestick Forum, who combine what Steve teaches with our divergence-based signals. They are wonderful when they confirm. What do you use for entry signals? So is the question is, we want to see a divergence, either a hidden divergence or for a trend continuation trade, or a regular divergence. We combine a trend indicator used differently for each, that lets us, you know, that we look for a confirming divergence. So we look for divergence in momentum and trend, and then when they turn up together with the candlestick in the direction of our trade, that's our entry signal, and we enter at the end of the signal, whether it's a 5-minute or a daily or a weekly. What is divergence is the question. It's explained in depth. It's a very simple primer. Divergence is essentially when price and a technical indicator do the opposite of one another. So if price makes a lower low and an indicator, so let me go back. I can actually explain it. On this 4-hour. So we have a price low with a momentum low here on the 7th. And then price makes a lower low. It could also be a double bottom down here. But if you look at our momentum indicator, it's higher. So that's a divergence. One is making a lower low while one is making a higher low. And when you have that in multiple indicators that take into account both trend and momentum, whereas a hidden divergence, which I can show you here, this is just kind of noise in the stochastic. But if you look at this pullback here, so we set a low here, and we have a low in the stochastic. Now we have a higher low, while the stochastic makes a much lower low. So right here would be a hidden divergence entry bull signal. So it's a trend continuation trade when we get this big wind up in the stochastic. So those are the two primary types of divergence. We actually teach 4 different types of divergence: triple divergence and compound divergence. But those are the 2 most widely used types of divergence. So price makes a double bottom or lower low while the momentum makes a higher low, or here price makes a higher low in a trend while we get a lower low in momentum. So I hope that's a good explanation, basic primer and divergence. Yes, JT, price making a lower low, indicator making higher low, and just flip that for hidden divergence. Price is making a higher low while the indicator is making a lower low. All right, any more questions? All right, well, thank you all for coming tonight. Steve, I think we're done here. Seems like we were right on time. Oh, Michael wanted to ask, did I have a divergence yesterday? There was a negative divergence in momentum, but trend indicators did not confirm that. The trend indicators we use did not confirm that, so we want to see something confirming. And I'll just say something about short signals. Momentum, you get a lot of negative divergences, and you have to have something confirm it. It's not nearly as important for bull signals, because, especially when we're in a bull market, but even in a bear market, momentum-only divergences are very strong. In a bear market, you get very strong bullish retracements, and divergence works great. But I just want to say that for bear signals, especially as long as we're in a bull market, you never want to take a divergence signal only off of momentum. You want something in trend to confirm. We did not have trend confirmation. We haven't had a bear signal in I don't know how long, which is good. I mean, that's a good thing, right? Trade the trend. By trend indicators, so some examples of trend indicators, like the MACD is considered a trend indicator. It's a indicator that is measuring trend as opposed to momentum. Jim, why use Keltner bands and not the cloud, the Ichimoku cloud? I actually know very little about the cloud techniques, and the Keltner channel has worked for us for years and years and years and years. If it works, there's no reason to randomly change. I don't remember offhand. Oh my God, what our MACD settings are? They're in the ebook, JT. So hopefully you can get that downloaded. If not, shoot me an email, and I'll send them to you tomorrow. I've got to open my chart. I don't know why. I'm just drawing a blank. Do I ever play with Nugget or Dust? I don't personally. No. Nugget is the miners, right? Here, let me share the link again for the ebook. Or Becky, if you could, somebody. And if you, for some reason, a couple of people are having trouble with that link, you can also get it at, there we go. Sure thing, Trav. And Steven shared it as well. Well, I want to thank everybody for coming. I hope you enjoyed the presentation. Hopefully you learned something. I hope everybody has a great evening and a good trading day tomorrow.
Brad, thank you very much. Good information. Again, everybody, this is information that's going to just kind of add to your arsenal of knowledge and what to look for. And again, Brad's got information that's just kind of common sense information that's going to dramatically help you see things or look for things. So with that, Brad, thank you, and thank you everybody for coming. It's probably warm enough for everybody to hit the swimming pool tonight. With that, we'll see everybody bright and early in the chat rooms tomorrow. Brad, thank you again. That was good stuff.
Thanks, Steve.